Hey, what's going on, cash flow hackers? It's Chris with Life 180. You can see I'm on the road, but I just launched a video the other day, and it was talking about whole life insurance policy loans. Do you need to pay the policy loans back, and how do you ultimately manage the policy loans? And I've had some comments, some engagement on that video, some questions that I wanted to be able to take some time and answer and really dive into. A couple comments kind of stuck out, and I just wanted to be able to take a minute and kind of respond to those, the spirit, I guess, behind those comments. And one of them, and let me just jump right into this. One of the comments had to do with utilizing policy loans for retirement. Now, I don't have my board, I'm on the road, but I wanted to kind of give this response while it was fresh in my mind, and on the road here, and I'm not gonna be home for a couple days, and I just didn't want to forget to do this. So here's the deal. When you're utilizing policy loans for retirement, it works a little bit differently, because obviously, the spirit behind some of the things I made a comment on the policy loans is you need to manage those policy loans. You need to service them. You need to pay the interest at least, and when you do, they work really well. When you do that, that really just depends on the maturity of the policy and what the desire and the design of that policy is, right? So if you're like, I'm 42 years old, right? So if I were to just start a policy today and I wanted to utilize that policy for retirement income supplementation, by the time, let's say I'm a classic person looking to be 65 before I do so, by the time I hit 65 years old, that policy is going to be 23 years old. It's going to have a lot of maturity, a lot of efficiency, and by the time I start to borrow against that, I need to just be able to run the numbers and be able to figure out how to leverage that for income in retirement. When I hit that stage, there are absolutely ways that you can do that, that it's not going to blow the policy up. Remember, in the examples that I showed in the last video, if you haven't seen that last video, by the way, I'll put it on the end screen, you can go check it out. But in the examples, in the 4 scenarios and 4 illustrations that I showed with what happens when you take a policy loan and pay it back, what happens when you take a policy loan in year 3 and don't pay it back, when a policy is kind of immature and new, and what happens when you take it in year 11, a policy loan in year 11 and don't pay it back. It functions completely differently, right? And that's because of the way that the internal fees and structures work. And one of the things that I'm really kind of on a kick right now to try to educate people about is that, this whole idea of positive arbitrage inside of policies is not true. I guess, let me say it this way, it's not true, and I still think a properly designed whole life insurance policy is one of the most powerful assets anybody can have in their life. It is still able to be leveraged, but I also think there's really a lot of danger in the positive arbitrage conversation around whole life insurance because of the fact that it is going to impact your behavior around how you utilize and leverage the policy. If you come into this thinking that you can get positive arbitrage and that when you put the money in, you can borrow against it and you never have to pay it back and you're not going to have any problems, well, that's setting you up for a lot of challenges, a lot of potential problems down the road. And honestly, they may be problems that you don't even realize until 20, 30 years down the road when it can ultimately blow up in your face. And that's what I want to help you avoid, is really having clarity about how this, not just what it looks like this year, not just what it looks like, if you want to utilize it and leverage it for real estate in 2 to 3 to 5 years, but what are those decisions going to have as an impact in your life 20 years from now, right? And that's 30 years from now. It's all important stuff. And so when it comes to retirement income, just to kind of answer this question, I still think life insurance is an amazing, amazing tool for retirement income supplementation. Is it the one thing that you should rely on? Heck no, absolutely not. You should not just put money into a whole life insurance policy. You should not just put money into an IUL and try to lean on that heavily for retirement income. Now, can you supplement retirement income? Can it be a portion of it? Absolutely. I think the best way to use life insurance is to have it as a kind of a tax-free bucket. It's fantastic. When you do that, I think it's important to also understand that you want to have cash flow and other assets that are producing revenue for you. The best way to utilize life insurance from an income perspective is to utilize it as a volatility buffer. You know, when we're in retirement, let's assume you're gonna be alive for 30 years in retirement, because if you hit retirement, chances are you're gonna live 25 to 30 years. And in that 25 to 30 years, you're gonna see a lot of market cycles, a lot of ups and downs. You're gonna have probably 3 what we would call boom bust cycles. And so the sequence of returns really matters. And so having a whole life insurance policy that's guaranteed, that's accessible, that you control, that you're not using every year, but that you utilize in the 1 or 2 bad years out of those 10 when we have the boom and then the bust happens, you know, you don't want to liquidate negatively performing assets. So if you can have life insurance, whole life insurance there to be that volatility buffer to help you kind of fill that gap to allow your other assets to recover, then it allows your whole portfolio to operate more efficiently. It helps the way that you can behave around it all. Now, at the same time, when you go to take money out of a whole life policy, sometimes you're not, well, I say take out. In this context, I actually mean take out. Usually I mean borrow against and leverage. But in this instance, for retirement income, a lot of times what will make sense is to do actual withdrawals up to cost basis. And in how a withdrawal works in a life insurance policy is you can surrender a portion of the policy, withdraw money, and you can withdraw up to the amount up to the cost basis or the total amount that you actually contributed into the policy, and not have to pay taxes on it. So you will avoid loan costs, you'll avoid taxes, and what will happen though is that it'll impact the growth and the dividends and all that stuff moving forward. So what I would do if you hit that point in time is work with the agent that you know, your agent in that scenario, and understand that you have options, right? So when you go to take this, I think that what I'm trying to like really make clear here is when you take the money for retirement, whether it's annually or whether it's utilizing it circumstantially or situationally in down markets, that way you don't have to liquidate negatively performing assets. You can utilize your life insurance policy to kind of fill that need. And when you do so, use a withdrawal, you don't have any loan expenses, you get up to cost basis, and everything can operate more efficiently, but you want to take a look at both and run kind of hypothetical in-force illustrations at that point in time to see how the policy will react moving forward, so you can make an educated decision as to what's best for you. So a lot of people don't realize that that is something that you can do, that you can withdraw from your policy, surrender a portion of the policy up to cost basis. But once again, you just got to kind of look at what the options are with an in-force illustration. If that was a little disjointed, I apologize. People were walking through and I had to pause, and I lost my train of thought a little bit while I was filming this video. It's a challenge of not doing this in my studio and doing this in a public place. But so that is the first thing, is like utilizing it for retirement income. You can utilize it, you should utilize it. I think this should be a component of it, but it's not just utilizing a whole life policy for retirement income supplementation. It's how do you do it, and what does the rest of your retirement income picture look like, and how does this fit in to kind of solve the needs of what your plans are, right? And so there's no one size fits all answer like everything else in life, especially with personal finance. There is no one size fits all answer with this, and so it's important to understand how it fits in your specific scenario, and then you can kind of go from there. So, all right, so the next part that I want to talk about is about utilizing life insurance as an asset. I talk about this a lot. Life insurance is not an investment. It is simply what I call the BASF of the financial space. If you remember BASF, it's like we don't make the products you buy, we make the products you buy better. Life 180, kind of lives and coaches people that life insurance, whole life insurance, isn't the investment you make. It simply makes the investments you make better. That's what I was just talking about in retirement income. The way it can supplement your retirement income is a very powerful thing. And from that perspective, it works in other ways as well, right? And so it's just, you have to understand what role it's playing in your life, what function you need it to play, what role you need it to fill. And when, because of the fact that I wrote my book, Cash Flow Hacking, and I've got this coming out, and I love utilizing life insurance as a way to kind of finance and make your real estate investments more efficient. I think it's important to kind of take a look at that and knowing how to design a policy, knowing how to set it up. I believe every single real estate investor in the world should have a properly designed whole life insurance policy as a cornerstone foundational asset that they utilize to make their real estate portfolio better, right? That's what this comes down to. And so when we look at it that way, this is where it gets really powerful. It's like, okay, I'm putting money into the policy. When you borrow against it to get a real estate property, let's say you get a $100,000 property, because that's the example that I used for the policy loan amount in the last video that I did on how policy loans work. The thing that I want to say here is, and I touched on this in the video, but I didn't elaborate in super depth. And the thing that I want to touch on is, okay, I go buy that $100,000 home. Like, let's just call it a $100,000 house. I'm in Cincinnati right now, and I was actually kind of blown away looking around. You can actually still buy a house here, an investment property, for like 130 grand. And it's a nice area too. Like, I'm actually really surprised. I'm gonna look deeper into it. But as you look at this, and let's just say $100,000 for the sake of argument, and over a period of time, let's call it over a 25-year period of time. The question is, okay, if I buy that house with the policy, and then I'm using the cash flow from that to pay the policy loan back, and I'm recapitalizing, as I pay that policy loan back, my collateral capacity increases, my liquidity in that policy increases, but all the while the money is growing, right? So think about it this way. If I have, on one side, I'm earning 5% and I have a 5% interest rate, right? So I got 100 grand, I borrow against it, I buy the house. I have a 5% cost. On the other side, that $100,000 is never interrupted because I'm borrowing against it, right? So it's still growing, and let's just call it earning 5% just for the sake of it. What happens is, if I don't manage that 5% loan, well, that means it's compounding against me. A lot of people like to say, well, it's simple interest and you're earning compounding. Well, that's not true, because simple interest turns into compound interest if you don't pay it, if you don't manage it. Because if I have 5% on 100 grand, the next year I got $105,000 if I don't pay that interest. And so now I got to pay 5% on 105 grand. That's compound interest working against you, right? Now, that money, if I do pay that $5,000 interest, now what happens is I still have 100,000 and I'm earning 5%, or I have to pay 5% on the 100,000 the next year as well. All the while, my account value has grown to 105, because remember, it earned 5% and now it's earning 5% on 105,000, right? So this is the power of leveraging this kind of arbitrage with your policy. Now, ultimately, what you want to do is you want to pay more down. You want to pay the principal down as well, because every time you do, and every time you pay more than the interest only in the whole life policy loan, it just increases your capital reserves. It increases the efficiency of the whole scenario and situation. And it reliquifies that money for you. So why not pay it back? You could put it in a bank, or you can put it in your policy. The policy is going to be the more efficient place to put it. And so the great part about that is, because you never interrupted the money growing, this $100,000 that's going to be earning money every single year, because you never interrupted that money's growing. But all the while, when you get 20, 30 years down the road, and maybe you got several $100,000, depending on what your premium amount is, maybe up to $1 million if you got a decent sized premium 25 years from now, you have that money in that policy, that money's going to be there regardless, right? That's there. And the internal rate of return of that money on its own is nothing to write home about. It's going to be better than a bank account. It's not going to be the sexiest thing of all time. It's not going to be anything that you can get amped up about. But if you leverage it properly to get real estate, now that real estate, because of the fact that you had this financial system, that real estate is worth, you bought it for 100, and maybe that property is now worth $250,000 or $300,000. It's tripled in value over 25 years. Okay, now that's exciting. You get to add that to what the real value is. Like, the value of what this policy did for you is actually realized in the value of your real estate portfolio. The value of the policy is also in the fact that, okay, had I paid cash for this home instead of using a policy loan, I would only have that $300,000, because all my cash would be tied up in that, right? Now, when I'm able to have the policy loan, instead of taking the cash flow and just investing it or resaving it for another house, I'm paying back the policy loan, and that cash kept growing, I probably have an extra $100,000 in my policy 25 years from now, just in the way I bought this house compared to paying cash for it, right? That is and that is because of the way that we manage the loans and we never interrupt this compounding. That is the leverage of what we do. But I just had to do this video because whether you're utilizing it for real estate now or whether you're utilizing it for retirement income, how you handle the policy loans is completely different. There's not a right answer. There's not a wrong answer. Because, and I would say, a lot of people would say, well, withdrawals are the wrong answer. You never want to withdraw from your policy. Well, in retirement income, sometimes it makes sense to withdraw up to cost basis and then take policy loans from that point forward. That can be one of the more efficient ways to go. You just got to run the numbers. You got to work with somebody who knows what they're doing and kind of go from there. So I hope that makes sense. On the real estate side, you always have to manage your cash flow. You always have to manage and service the loan. It's great because it's unstructured. It's great because you have a lot of flexibility on how you manage that. But sometimes that flexibility can bite you in the butt. It can make it so you make poor decisions around it. And that's the last thing I want to see for you is bad decisions around how you kind of manage that money because that can cost you a lot as well. And so at the end of the day, properly designed whole life insurance policy, you should be excited about it. You should realize that by putting money into it, by paying this loan back, you're putting that money back in, you're regaining control of that capital. That is in your financial world. It goes into this policy, which is the filter that helps you make better financial decisions, whether it's investments in real estate or business or anything. How you handle this tool can also pivot. You can utilize it for real estate and accumulation, and all the while it's growing up, it's building up, and then when you hit retirement, you can then pivot and start utilizing it for retirement income. How you manage those loans is going to be completely different, and how that policy functions in your life is going to be completely different. You just have to pivot in your behavior and your understanding of how you're leveraging it. But it's cool. It's like this whole life policy, when done properly, can be the Swiss Army of financial products. You just have to understand how to use the tool properly to be able to get the most out of that tool. So that is it. I hope it makes sense. Hopefully this gave some clarity to the last video I did on whole life insurance policy loans. And yeah, if you have any questions, you need me to elaborate any more, go ahead and comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. Check this out in the end screen if you didn't watch it, or if you did watch that video before, I encourage you to watch it again because going through those policies, really understanding is really important. So anyway, check it out. Have a blessed, inspirational day. We'll talk soon.